Most traders don't lose because of bad setups. They lose because they don't understand how the market moves before it moves. You see that perfect double top, that clean break of structure? It's not the setup failing, it's you getting induced. In this video, you'll finally understand the real liquidity and inducement cycle, the part most traders skip when learning institutional order flow. By the end, you'll know exactly where liquidity sits, how inducement forms before every real move, and how to trade that with the institution. And at the end of it, we will jump on the charts and apply the concepts we've covered in this video. In this liquidity blueprint, we're going to break down everything through the cycle of liquidity, which is liquidity, traps, liquidity sweep, then distribution, and further continuation or reversal of the distribution candle. The first thing we will be looking at is what exactly is liquidity and why is it so important within the market? The difference between an inducement and a liquidity sweep, the three types of inducements that are formed within the market and the forms that it can come under, how you can use it to profit by utilizing the cycle of price, and then finally we will wrap it up by reading and understanding the price through liquidity. So grab your notebook and lock in, because once you understand this, you'll never look at price action the same way again. The first thing you need to understand is what liquidity actually is. At its core, liquidity is simply orders or the flow of money in the market. Market moves because of this flow. When there's more buying pressure, price rises. When selling outweighs buying, price falls. But for a strong move to occur, whether bullish or bearish, price needs to reach an area packed with orders. There's where big players step in. During normal conditions, the market drifts through the ranges because there isn't enough interest. Buyers and sellers are balanced. But when price reaches these key zones like a swing high or a swing low, it suddenly reacts. The reason for this is these are the points where liquidity sits, where clusters of orders get triggered, and that's often where the most powerful reversals begin. Think of it like this. Every stop loss, every breakout order, every pending limit, that's liquidity. It's where money is sitting. It's where the big players, banks, hedge funds hunt for fills. So when it is said follow liquidity, it basically means track where price is likely to be drawn, because that's where the orders are, that's where the real move begins. Now here is where inducement comes into play. The idea behind an inducement is before price reaches those major liquidity zones, the market often creates traps, fake setups that lure traders in the wrong direction. These traps are called inducements. In a moment, we will discuss the type of inducements, but for now, think of it as fake breakouts. Two clean double tops or bottoms, bullish trendline bounces that tempt late buyers or early sellers. Once the trap is crowded and stops are stacked, price reaches up or down, sweeps the liquidity, and only then delivers the real move. So, to sum it up, inducement is the setup that lures traders in. Liquidity sweep is the execution that clears them out. Therefore, inducement sits at the core of my playbook. Every trade, reversal or continuation begins with an inducement read and only survives if it passes my layered hierarchy of confirmations. So with the types of inducements, we have major, medium, and minor. These inducements are not restricted to a single time frame. The best way to differentiate between them is paying attention to the time of the formation of the swing high or low. Now looking at major would basically be a swing point that was formed more than 5 trading days ago, and the price action you're analyzing induces that point, hence creating a major inducement. First, we need to understand what the market structure is saying. So price created lower highs and lower lows, so clearly bearish. The supply zone sitting at the lower high here was formed at the 13th of August, and the price action that we're actually analyzing right now is the 2nd of October. So clearly the swing point was formed more than 5 trading days ago. Now at London Open, price then nears the supply zone and we start to get reactions. However, these reactions are still bullish because of the liquidity inducements that are happening to the downside to create these highs. You have breakout structures as well, confirming the bullish intent. Once this supply zone is fully induced by London high, then we can start to spot bearish intent through bearish breakout structures. So if you were looking to get into any sorts of sales, this was your opportunity to get in a high probability sale setup. Now moving on to medium. Medium would be a swing point that was formed within the previous 5 trading days, and the price action you're analyzing induces that swing point, hence creating a medium inducement. With medium inducement, it is not always the case that the price would target something externally. An internal structure or a control zone could be the target as well. If you don't know what a control zone is, watch my previous video where I explain it in detail. Now, medium inducement is a characteristic of an A+ setup, and you can expect the market to present you with this move more often than not. Now, how can you spot this? Now, let's say the market is printing bullish structures. So you had a higher high, higher low, another higher high, another possible higher low after the breakout structure here. However, that's not what we're going to be focusing on alone. The tradable, meaningful moves within the market will always be in a combination of market structure and inducements. And when London opened and it induced previous day low, which was the 1st of October structure point, and then gave the proper bullish intent through breakout structure, is when the real move kicked in towards the upside. Minor would be a swing point that was formed the same trading day, and the price action you're analyzing induces that point, hence creating a minor inducement. For any trade to happen, we need at least a minor inducement to take place, whether that's for a London session or New York session. Now that could be in the form of London inducing Asia high or low, or structure midst of Asia range, or for trading New York session, inducement of the same day liquidity. So when New York opens, it goes higher, induces a structural point that London provided. That is also considered minor inducement. Now all you need after that inducement is a lower time frame confirmation, and then you can get into possible sales. Now we know the types of inducements. Let's talk about the forms they can present themselves in within the market. Some forms of manipulations could be supply and demand. That's the most classic one. Then you have external swing high and low. So you can have the price actually creating higher highs, higher lows. An external point created here. Price can go up, sweep that swing high, and then give you some sort of possible bearish reaction. You could also have internal swing highs and lows, so control zones, which would basically be if a price is creating higher highs and higher lows, let's say price makes a pullback and then pushes it out again in this manner. Now in this case, you have the extreme demand zone here, but this point here, which is responsible for the final push, for the final breakout structure, would be considered your control zone. So price can actually come down, induce this control zone, and then go higher. Then you have the previous day high, previous day low, or previous weekly high, previous weekly low, your session highs, lows, equal highs, lows, your trend line, smart money traps. Now the double trap manipulation, how can that look like within the market? Let's say price is creating a bearish trend line, something like this. So you have a bearish trend line here, and equally you have these equal lows price presented itself. Now what price can potentially do is it can sweep one side, so you can have the sweep of the trend line liquidity, and retails will think that, oh, the price is ready to actually reverse and go bearish. What price would potentially do is come down, sweep the equal lows as well, and then create the actual move. So it induced the sellers at this point, and it induced the buyers that were getting at 1 touch, 2 touch, 3 touch. Finally, the cycle of manipulation. This is basically outside of your point of interest, outside of mainly supply or demand zones. Now let's say that the price is carving out a clean triple bottom. First touch, second touch, third touch, On the fourth touch, there's buyers getting into the market. If that zone also sits inside a higher time frame demand area, you've just layered stops from classic support and resistance players and supply and demand traders. As the price goes higher and prints bullish structures, more buyers jump in off the trend line and newly labeled demand zone here, adding yet more stops below these points here and finally below this one here. Now comes the next phase. Price pushes lower and stops at all the buyers that go in from this trend line or based off of this demand zone. After the sweep, some read the push as a bearish break of structure. So you have this one here, a break of structure here. And now what they do is they look for a lower high, that could be this one here, as a local or the closest supply zone. They wait for a bit of a pullback and they look for sale setups. Now, as the trap appears on the pullback, sellers stack orders with stops stocked above. So you have seller stop losses sitting all the way around here at different price point. Now, both sides are exposed. Seller stops above the cleared highs, buyer stops below the retrace. What does that lead to? The market inviting in buyers and enticing sellers. Now, what does it do? It runs both. It takes the buy stops that we're presenting here and all the way around there with this move to the downside, and then finally inducing these equal lows, it goes higher and takes out the seller stop losses that were resting above here. Now we know what forms they can appear in. Let's talk about where within the price action they can form. Inducements can show up anywhere. Sometimes they form inside a point of interest and act as an inducement of that point of interest. Other times they appear with no point of interest involved at all. That's why this goes beyond pure supply and demand or simple market structure, because you can still read the narrative even in a no man's land during a structure leg. Now let's look at the point of interest in a bit more depth. Let's talk about the first one, which is the manipulated point of interest. So we have a supply zone here, which induced liquidity to the left and then gave a break of structure, maybe pointing towards a bearish momentum. However, we make a pullback and approach the supply zone, but there is no confirmation of inducement, which would signal towards the direction. Price keeps pushing higher into the area, leg after leg, without creating any rejections or shifts that would qualify any of these pockets as real inducements. In this scenario, I am not forcing sales just because it's in a supply zone. I'm comfortable taking tactical buys until the market completes a medium inducement in the form of a previous day high. This is exactly what happens during New York Open. Price goes higher, induces previous day high, which is your medium inducement, and then makes the real move to the downside. When that finally happens, all we have to do is wait for a lower time for confirmation, showcasing a bearish momentum. Then it's all about executing that sale. This approach does two things. It stops you from losing money on every unconfirmed setup inside a point of interest, and it opens up an opposite prospect, which is buying inside the supply zone while everyone is selling and then flipping short the moment the narrative actually confirms. This way, you can easily catch 40 to 50 pip move and be done with the day. Now, price at London Open goes lower, induces Asia low, and also induces these intra-session liquidity points coming from the previous day and this trend line liquidity. That sequence, Asia low taken, previous day swing low taken, trend line stops cleared, is the real inducement. Basically, the real move for the price to reverse from. Once we confirm it through lower time frame confirmation, the reversal kicks in and we often see a very sharp volatile move. Now, why does that work 10 out of 10 times? Because the market moves on liquidity and liquidity brings volatility. When you're at the right place, at the right time, with the right liquidity taken, you get the perfect storm for a high quality move. Not a tiny pullback, but the real shift. Follow through with inducements and clear market structure change. Now let's talk about the low probability point of interest. This is when price is not at your point of interest. So it could be price being outside of a supply zone or a demand zone or one of the control zones. So price at Asia ranges. It consolidates, doesn't do much. At London Open, price goes lower and induces one of the structural point. Now this structural point here, in terms of importance, it is way lesser than the one that is at a control zone or the extreme one here. This here isn't an external structure, neither it is a controlled demand zone. So inducement of it would be classed as a no point of interest. The problem with no point of interest is you have multiple risks you might encounter. Number one, it could be a context risk. Without a point of interest, you might be buying into a premium or selling into a discount where the bigger players aren't even positioned yet. Number two, you could have a narrative risk, which is a sweep and a break of structure can be counter-induced on the very next leg. Without a point of interest behind it, the move often lacks follow-through. The third type could be a fake-out risk. On M1, M5, you'll see infinite micro sweeps. No point of interest means more trades, more variance, and more noise. Now, there are ways to counter this. So let's set the minimum rules for a no point of interest setup so you avoid taking unnecessary losses. Now, what you want to see within the price action is a clear liquidity sweep. This sweep can come in a form of a previous day high, previous day low, equal highs, equal lows, trendline liquidity. These are just some examples of it. You want to see a true displacement happening as well, meaning impulsive candles towards the direction you're targeting. Then you want to see a lower time frame confirmation, so a liquidity sweep and then a break of structure on your entry time frame. Then you want the level to be retested or mitigation only. If it misses, let it go. The next thing you want to be looking at is the time. You want to be trading London Open or New York key window and combine it with the next liquidity. And the last one is basically when you have a counter break of structure against you. That is one of the hard invalidations within the price. These rules make a no point of interest viable. However, the same checklist inside a point of interest makes it better and reliable. Now let's move on to the next important aspect of trading good setups, which is time. Time isn't just a backdrop in trading. It is part of the edge. Price, liquidity, and volatility don't show up evenly. They cluster at specific times. If you line up your setups with those windows, your trades tend to move quickly and hit targets faster. So basically, when you pair inducement with time, you create a high probability trading environment through which you can trade either the continuations or reversals. Now, every setup needs a point of invalidation, the exact price or time that proves your idea is wrong. No emotions, no debate. If it hits, you're out. This is how you protect your capital and your mindset. Some common types are time. It can also act like a point of invalidation. I trade 2 fixed windows and I don't deviate. 2 hours at London Open and 2 hours around New York Open. If I found a winning trade during London session, then I don't trade the rest of the day. I'm not glued to every candle all day. I give the market these focused hours. If an inducement and confirmation prints inside those windows, it is my setup. If it doesn't, I pass. The next form is key levels that break your bias. Now let's say price created lower highs and lower lows. So you have an extreme supply zone here. The break of structure was given at this point. This point here was responsible for the final push. Let's say price makes a pullback, right? It induces this control zone and then it is moving towards the upside, towards the extreme. Now, I'm not going to look for any sort of sales with this inducement alone. I would want the price to tap into the extreme supply zone and then give me some confirmation to go bearish. Other types of session invalidations that you can find within the price is strong objective being taken, no lower time frame confirmation, or liquidity run without a reaction. Now let's say price is creating lower highs and lower lows. Price goes higher, induces this lower high, and after the inducement at this point, it shows no sign of slowing down, no signs of reversal. It might just be creating more bullish structures all the way to the upside. Now, in this case, that is what we considered a liquidity run. We're not going to be forcing any sort of trades within this price action. Now the last one is double trap manipulation. This I covered in the forms of manipulation already. Now, if you want to learn how to apply this live with me, my mentorship dives deep into liquidity, inducement models, session timing, and entry execution step by step. That is why inside Elite Traders Hub program, we trade together every single day, have daily analysis shared, question answer sessions, psychology talks, community calls, and one-on-one guidance every single week. And when you combine all of this together, if you want to really change your trading, come join us and you'll see the difference. That is why we've had members that have made thousands and thousands of dollars in payouts and more than $500,000 funded by one person. If you're ready to master this for yourself, the link to book your one-on-one call will be in the description below. All right, let's jump into price action at M1 time frame and look at it through inducements to inducements and identify whether the buyers or the sellers are in control. Now, when price arrives at the supply zone at London Open, the first thing that pops up is the price induced minor liquidity. Took the trend line that Asia range was forming basically. So we had one touch, two touch, three touch. The sellers are loading in only for them to be induced by this push up. Now you might wonder how the price is actually fueling this move to the upside. It did that through grabbing the liquidity to the downside, which was another trend line. So this low here induced that trend line here and gave you a break of structure, pushing the price higher. This fuels the move higher, enticing more sellers than taking them out. So we actually had the price action doing something very similar. So you had one touch, two touch, three touch. People are selling the asset from this point here only for them to be induced. Their stop loss is taken with this push up. Now what happens once price has pushed higher is that obviously it took this trend line, but it also tapped into an imbalance, which is the confirmation that an objective is actually complete and it is ready to go lower. Now that the price takes the trend line and taps into an imbalance here, and all of that happens within our supply zone, that is when the real move happened. Now that's where your London move to the downside is actually taking place. So what happens at pre-New York is buyers are basically loading in from this point here. You had one touch, two touch, three touch, without any market shift basically. Them considering this as a triple bottom, they're actually getting into some sort of buys. So for us as liquidity traders, we know that this push up to induce this point here was just to grab more fuel to deliver price lower. And bringing back the cycle of liquidity I mentioned in the beginning of the video, which is liquidity, traps, liquidity sweep, and then distribution. This is exactly what we're going to see within the price again and again. So once the break of structure is given here, price makes a pullback into a point of interest, which in this case is in a form of an imbalance. And this is where you could have gotten into some sort of sales targeting something to the downside. There's something exciting actually happening here. Let's zoom into it and see what that is. So when price makes a pullback into this imbalance, we also realize that there's a whole area to the downside that is becoming a trend line trap for more buyers. So when price actually creates this quote unquote demand zone, people are getting into further buys only for them to be induced by this move to the downside, because we know that is a trap and that's a demand zone that's not going to hold. Now at New York Open, we had another trend line forming, but what are the smart money traders thinking? They saw all these equal lows induced by this swing low, and then it also gave an internal break of structure at this point. So buyers would be looking for a pullback target to go higher. So what happens is at New York high, price does another inducement of these equal highs and then gives you the break of structure to actually target this trap. So this is basically a whole day of price action. You could have actually waited for the price to come back up into some sort of point of interest and then look for further sell positions. So you can see that sellers are actually in control. And how are they showing control? Through inducements of those buyers. So this is basically showing that inducements are what lead the show and set the narrative within the price. So Asia low being induced here allowed the price to go higher, grab the bearish trend line that was forming within the Asia range and then go lower. The small inducements while the price is being pushed out, like this trend line liquidity inducement or these equal highs being induced at New York Open, shows further confirmation towards the sellers being in control. Then just before New York opens, we formed a trap to push the price higher, take some more liquidity to the upside, and then finally break structure to the downside. Inducements are everywhere. They are constantly provided within the price, but the best way to know which one to trade should always be in combination with time, point of interest, and lower time frame confirmation. Now to wrap it up, the mindset shift is simple. Don't predict, track the draw on liquidity, then wait for inducements to complete it. When the trap springs and structure confirms, you're no longer guessing at direction. You're partnering it with the cause that creates it. So next time you sit down to trade, remember, you can either be the liquidity or you can trade with it. The choice is yours.